Now, it's a very simple model, and it's based on two variables, and I think that they're the two variables that we worry about most in our life, and that is growth and inflation. The problem we've got now is that even though inflation is only, in inverted commas, 4%, putting your money in the bank earns you nothing, and actually even buying government bonds only earns you about 2%. So you've got a gap. You've got to do something. And the problem is it's just at the time when we all feel very little like taking risk. We have had quite enough of that, thank you, for the last 4 years. Cash does not get you there. The yield on government bonds does not get you there. You have to start moving into riskier bonds and equities to get you over that line. So in 2008, if you bought the right sort of bond, you got a very good return of 9% even in 2008, and if you bought the wrong sort of bond, you lost a quarter of your money. Ouch. But you don't actually want that degree of scaredness and volatility in your life. What you actually want is a manager who does that for you. And a manager who recognises that different types of bonds do well at different times. So you want a manager who is going to give you all the different types of bond and is going to dynamically adjust the different types of bond in a way that is appropriate for where you are in the cycle. And a lot of managers are calling these things strategic bonds. When you hear the word strategic bond fund, basically it means a manager who has lots of different types of bond in the portfolio, not just one sort, and is trying to manage that to get to a yield that is more than inflation. The second thing is equities. Now, I know we've probably had enough of equities, but it's thinking about equities not from a capital return, but from what they pay you in dividends. We tend to forget that equities pay dividends. And what is really interesting is that you look at it over the longest period, most of what we earn from equities, the red line, is actually dividends. The actual capital growth in equities is actually quite low. And it comes back to the ninth wonder of the world, which is compound interest. So actually, if you get the dividend, if you can get a stock that's paying you 4% a year, by the time you compound that up, that actually is very nice return, thank you very much. 4% a year gets me up to where I need to be for inflation. And actually, I don't need to assume that the stock market level goes anywhere. The stock market level could be absolutely flat. I'm not making any prediction there on my capital return. I'm hoping over the longest term that it doesn't go south, but I don't need it to go anywhere for me to be able to get up to a rate of 4%, which is my magic rate. That's what I've got to do. So I need to find equities that are paying me about 4% per annum. And the good news is that there are a lot of these in the world today. So even if you don't like the risk of equities from a capital point of view, if you can find equities that pay you good income, sustainable income, then you can get across that gap at a reasonable level of risk. Be good, because I think that in all my 30 years of doing this, if there is one mechanism that will help a non-professional to understand what professionals are talking about, it's this mechanism. I hope that's been interesting. Thanks ever so much for coming, and I look forward to meeting some of you later.